all. Welcome to Q1 FY24 earnings call of Repco Home Finance. Firstly, we thank the management for giving us this opportunity. We have the top management team along with us, Mr. K. Swaminathan, Managing Director and CEO, Mr. T. Karunakaran, Chief Operating Officer, Mr. N. Balasubramaniam, Chief Development Officer, and Ms. K. Lakshmi, Chief Financial Officer. Now, I would like to hand over the call to Mr. Swaminathan for his opening remarks on company's performance and the outlook. Post this, we'll open the floor for questions. Over to you, Mr. Swaminathan.
Thanks, Mr. Mehta. Thanks, Mr. Jacob. We would like to welcome all to the earnings call of RHFL for the quarter ended June 30, 2023. Thank you all for joining us in this call today. As an introduction, we are happy to announce we are on the right track and continue the momentum of the previous years. The company is really progressing on its business.
Ladies and gentlemen, we've lost the line for the management. Please stay connected as we have the management line reconnected. Ladies and gentlemen, we have the line for the management reconnected now. Thank you, and over to you, sir.
Thanks, Mr. Ajay. Sorry for the interruption. Once again, I'll start. We welcome all of you to this earnings call of the first quarter of 2023-24. We are happy to announce that we are on the right track and continue the momentum of the previous quarters. The company is steadily progressing on its business parameters and is confident of meeting its guideline numbers. The company is in the process of making structural changes in the organization, the results of which would become visible in the coming quarters. As regards business updates, we were able to achieve a disbursement of 684 crores against 640 crores of Q1 FY23, registering a growth of 7%. Our sanctions stood at 726 crores as compared to 691 crores of Q1 FY23, reflecting a YoY growth of 5%. It is worthwhile to note that the sanction and disbursements in Q1 of last year included a DA pool purchase of 70 crores, while there was no such pool purchase in the quarter Q1 of 2024. Our AUM stands at 12,653 crores, increased by 2% QOQ, and from the previous quarter of 12,449 crores. The ratio of exposure between non-salaried and salaried segment stood at 31.8% and 48.2% respectively. The share to non-housing loan, that is home equity, stood about 23.1% of loan book, and housing loans contributed about 76.9% of the book. We were able to reduce GNPA from 719 crores to 695 crores, which is 5.5% of the AUM. The NPA stood at 338 crores at 0.8%. We have a provision of 524 crores, provision coverage ratio of 51.4% for the stage 3 assets. As of June 30, 2023, we hold 600 crores of restructured portfolio, of which approximately 200 crores is in stage 3. Our NIM for Q1 FY24 was at 5.1% as against 4.6% in Q1 FY23. We have been able to successfully transfer the increase in our borrowing cost and also improve our margins. We continue to operate at a speed of 3.3%. Our average yield on the incremental loan sanctioned rose to 11.56% in Q1 as compared to 11.08% previous quarter. The profits grew 8.5% QOQ and 43.5% YoY, amounting to 89 crores as against 82 crores in Q4 FY23 and 62 crores in Q1 FY23. Our ROA and ROE improved to 0.8%, 15.8% respectively in Q1 FY24, as against respective figures for Q4, 2.7% and 14.4%. During Q1 FY23, we were a little aggressive in recovery actions, and more than 1,340 SARFAESI notices have been issued during the last quarter. Similarly, we are also happy to announce that the company has implemented a salary revision of all staff members with effect from January 2023. These measures might have contributed a little increase in our total cost, but we are confident that the package as well as recovery efforts will give a good result for the company in the coming quarters. We also expect a drop in our attrition ratios. The new software, as indicated in our previous meet, the new software package is already in place in all the outlets. Besides, mobile applications under phase 1 of the project is on the verge of completion and shall be rolled out immediately, performing a security check. Certain add-on functions to this particular rollout, mainly to facilitate decision-making in head office, would be implemented in the coming months. Branch network. As of June 30, 2023, we have 193 touch points across 12 states and 140, comprising of 159 branches, 34 satellite centers, with additional 2 asset recovery branches. In the month of July 23, that is in the second quarter, we have already upgraded 7 of our SAT centers. We will also be opening 3 more SAT centers this quarter. By year end, we will be having more than 200 outlets. To summarize, the key financial highlights for the quarter are the loan book standing at 12,655 crores, registering 7% year-on-year growth, PAT at 89 crores, ROA and ROE at 2.8 and 15.8% respectively. The core profitability has remained strong with a solid spread margin of 3.3 and 5.1% respectively. The gross NPA stood at 5.5% with coverage of 51.4%. Net NPA is at 8%. For way forward, for FY23, we had to stick our guidance numbers of 30% growth in sanctions and disbursements and 12% AUM growth from FY23. The GNPA numbers are planned to be brought down by at least 100 crores, of which we have already reduced 24 crores. Thank you very much for the opportunity, and we are open to questions by all the people here. Thank you. Thank you very much. Thank you, Rajiv, once again.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Amish Thakkar from Blue Gulf India Advisors Private Limited. Go ahead.
Hi, sir. Congratulations on great set of numbers. Just want to get some clarity on your disbursement growth. Any guidance on full year and how you expect to get to about 1,000 crores per quarter? And if you just found by any estimate of new branches that you're planning going ahead, and break it out by state also, because the AUM creation in your home market is in single digits, while a couple of other markets are growing at double digits. At the same time, Gujarat has been negative, so what's the issue in Gujarat and filling down that portfolio, if you can just give us broad pictures or high level on each probably look at them.
Okay. Thanks, Mr. Anish. I think if you exclude that 70 crores of DA book which we did last quarter, that is year on year, we have grown by around 20% as disbursements are concerned. That's why we plan to maintain the same as far as disbursement numbers are concerned. Going forward, especially the first quarter is normally a lean quarter, we have grown 20% year on year. So in the current year also, we are planning to increase the total disbursement number from around 3,000 crores last year to around 3,600 crores this current year. So we are on track. We are confident that we will be able to achieve the numbers as far as disbursement numbers are concerned. As regards AUM, I think we were around 12,400 in the beginning of the year. We plan to reach somewhere around 15,000 crores by the current year end. That is our plan of action. Hopefully, when the increase happens, when the momentum happens, especially the second and third quarter or normally peak quarters for the year. So during the second and third quarter, when the increase or the momentum picks up, definitely the book growth also will be more than the 9% growth that we did last first quarter May. So definitely, I think we will be able to reach a number of around 14,000 crores. This is our plan of action for the year end.
Is there anything on branch expansion strategy going forward, and what's happening in Tamil Nadu? Why AUM growth there is 7-8% versus double-digit growth in some other markets? How do you see the market in Tamil Nadu playing out where percent of AUM is sitting there? So
Actually, Tamil Nadu is doing well. That is, see, even the repayments, we are able to maintain the share of Tamil Nadu in the book, which implies it is also giving us new businesses. And we are opening, I told in the previous call also, we are opening satellite centers in Tamil Nadu because these where we are opening these centers are mostly in Tier 2 or Tier 3 centers. So we are happening in the form of a SAT center in Tamil Nadu, whereas in other places we directly go for branch opening. And Tamil Nadu is contributing a bulk of our business. More than 50% is being given by Tamil Nadu. We plan to maintain the same ratio. As far as numbers are concerned, I told in the initial thing itself, it will be somewhere around 200 plus by the year end. Tamil Nadu itself, we will be opening another 6 or 7 offices before the year end. And other places, 10 branches we will be opening other than Tamil Nadu. So by year end, I think we should be somewhere around 200 plus offices.
And you seem to be actively responding to portfolio in Gujarat. It stands at only 2% of book, but have you stopped new disbursements completely there, and it's like the same issue that industries in the Surat region, or is it something else there?
Nothing to that, sir. See, comparatively, we are not all that popular in markets in West compared to South. So that is why there is a slope as far as markets like Gujarat, as you are saying. And we are positive. We will be opening some of the branches in Gujarat. Some of our branch extensions are in Gujarat only. Once the infrastructure, including the human capital, is there, we will be opening branches in Gujarat. We want more growth in Gujarat because that is an improved growth market for us.
Okay. And this 15,000 crore target, you're factoring in any BT out, that happens,
Yeah. See, what are BT outs as well as the normal rundowns have all been factored in our 14,000 crores. This is a normal thing. And to answer your question on BT outs, I'm happy to announce that BT outs are relatively less than BTNs. There is a reversal in trend that we have noticed in the first quarter. Hopefully, if this continues in the coming quarters also, I think we will be able to handle these BT outs, which was one of the areas of the company in the last year.
And any guidance on this portfolio purchase that you did in Q1 and Q4, will that continue in this financial year as well?
Frankly, as an organization, we want to grow organically. Let us be very clear. When an opportunity comes, such as DA is concerned, definitely we will look at the option, provided it is profitable. Gives us.
Okay. Thanks a lot, sir, and all the best.
Thanks, Mr.
Thank you. The next question is from the line of Aniket Kulkarni from BMSPL Capital. Please go ahead.
Thanks for the opportunity. So during the initial commentary, you spoke about some structural changes which company is going through, and you said the effects of which will be seen in the coming quarters. Can you just give more detail on what are the sorts of changes which you are doing and how will it affect the business going forward?
Thanks, Mr. Kulkarni. This company was not having verticalization in place in all these years. Okay, this verticalization we have started doing. And in the last call also we had told about a collection vertical that was implemented. In the current quarter, that is, we have also started a sales vertical separately. Going forward, we will also be adding a credit vertical. So this collection vertical is more or less stabilized, even though the results are coming. Sales vertical is in process. It is just 1 month over. Going forward, I think sales vertical also will be giving us more volumes. So this is what normally we were talking. In addition to that, I think we have also done some certain changes as far as the software is concerned, which I mentioned in the remarks. So all these are just a brief. In each and every department, something or other is happening. But basically, some sort of a verticalization has started happening in this company. And we are confident that this is going to give us results.
Okay. Thanks for the answer and best of luck.
Thanks, Mr. Kulkarni.
Thank you. The next question is from the line of Ajit Chupewal from Motilal Oswal. Please go ahead.
Yeah, thank you. And sir, just wanted to understand the data point. If I look at your disbursements, have you already shared the split of your disbursement between home loans and LAP?
Yeah, home loan and home equity we have given, no? Hello?
So has that already been provided?
Yeah. I think it's already provided. I can give you once more.
Yeah.
1 minute. I will tell you. I think we have given the date. I will give you the number. See, as far as home loan is concerned, it is 9,735 crores and home equity is 2,919 crores.
This is the split of your loan book, right?
Yeah, loan book.
No, sir, I was asking actually about disbursements. So for this quarter and maybe the last, because if you give the split of your disbursements in home loans and LAP, in home equity.
Sorry, I do not have really available. I will see whether I can give you before the end of the talk.
Sure, sir. So the other thing I was wanting to understand is very, very clearly we have started to demonstrate some growth in your advances now, which is broadly around 12,650 crores now. What is a little worrisome here is if you look at home loans, right? Home loans has grown just about 2% year over year, while your LAP book grown about 28% year over year. So I understand, the things that we've been through, but historically speaking also, LAP and the self-employed segment has been a problem area for Repco. Even if I look at gross NPA numbers that we share, basis product segments, there also if you look at it in home equity LAP, right, we have NPAs of about 10%, almost about 7-8 quarters back, which is now at 7%. So why is it that we continue to do well in LAP? There we are not seeing a lot of outs. As a matter of fact, our book has been growing. 28% is very strong growth. While housing loans, which are more safer, there we have just seen a 2% kind of a YOY growth.
Mr. Abhijit, one clarification I would like to make. It is exactly LAP book. It's what we put as home equity. So it's not that entire non-home loan are all LAP. This so-called home equity consists of 2 or 3 segments. One is of course LAP, which may be a major thing. The other thing is on a commercial, even a commercial real estate one. Second, let's say a home loan with 3 kitchens. We call it as home equity. All these come under home equity portion. You may also be remembering recently RBI came up with a circular. Wherever some reimbursements happen, even in case of a home loan, it is not to be considered as a home loan. So all these together come under a non-home loan portfolio. So even though we would, technically speaking, these may be home loans, they are classified more from a supervisory point as a non-home loan. That is why I am saying, as far as the non-home loan portfolio, I do not want to take it entirely as LAP book. Second, to your question, yes, LAP is giving me some margins. And we are very, very clear, even in case of LAP, whatever the portion, even in case of LAP, all our normal requirements like CIBIL score or the quality of the client, all these are taken into consideration before we sanction the loan. The entire risk parameters are all parameters in our LLMS. All these are taken into consideration. So let us not have a view that all LAP books will be riskier. Of course, by the nature, the NPA percentage of a home equity will be higher than a home loan. And second, in home loan, there is competition. Compare it to my home equity. So my growth is also happening this way. And this particular quarter, it is more because of the change in the nomenclature due to supervisory thing. There is an increase in a non-home loan portfolio. And to come to your, got the disbursement for the current quarter, it is 410 crores housing and 274 crores home equity. Previous, let us say, 480 crores. In June 2020, it was 480 and 162. And the March 23, it is 555, 280. So it is happening. Always the home housing portfolio is more than home equity portfolio. And I again repeat, it is not that all non-housing loan portfolios are LAP.
Okay, sir. Also, this thing that explains the change in product mix, a sharp change in product mix we're seeing this quarter, where home equity portfolio has moved up from 20.7 to 23. This is purely a reclassification or the change in guidelines and nomenclature is what it's about.
It should be mostly because we have taken all that. Nearly, I do not have exact number, but post the circular, we have reclassified all our reimbursement loans as home equity portfolio. Of course, there may be an increase in the home equity portfolio in the current quarter. I am not denying that, but it is mostly because of the reclassification.
Okay. The last question is, how should we now look at the asset quality? Obviously, under your leadership, the asset quality has continued to improve. In your opening remarks, you also talked about the guidance, where for the full year you talked about bringing out the NPAs by about 100 crores, almost a quarter of that you've already achieved. So how should we look at asset quality going forward? You talked about initiating a lot of staff AC. So that's all my question. How should we look at asset quality and also credit costs for the full year?
As far as asset quality, whatever 100 crores we have given was relatively a conservative estimate. We want to be especially conservative as far as asset quality is concerned. Mainly because of the restricted portfolio that is still there in the NPA as well as stage 2 number because of that reason. But as you mentioned in the opening remarks, as you have mentioned, we are going slightly aggressive as far as interventions are concerned in our NPA portfolios, stage 3 portfolios. We are confident that all these efforts will bring the NPA numbers still down. We may even better our guidance as far as NPA numbers are concerned. We continue to monitor almost on a daily basis, on a monthly basis. Definitely, we will be in a position, in my view, we will be in a position to monitor unless something drastically changes.
Got it, sir. This is very clear. Thank you so much for patiently answering my questions.
Thank you. The next question is from the line of Anand Munta from Shore Wealth. Please go ahead.
Yeah, hello, sir. Sir, want to check you, how do we plan to grow our business by increasing ticket size or increasing branch productivity or opening new branches? Because when I was doing maths, it looks like branch productivity is already very good.
I have slightly different opinion, Mr. Mundra. There is still scope for improvement in productivity. That is where we are driving. Because we will be opening more branches. There is branches also will give us business, no doubt about it. The verticalization that I was talking about, that is only for improving the productivity of our staff. Because some portion of our existing staff are going to earmark exclusively for selling to our customers, approaching new customers. So more and more customers we branch out rather than walking customers. I think with all this, we want to improve per staff productivity or per branch productivity. I think that really means our growth for the year as well as for the coming years.
Sir, I visited few branches, so I realized that we don't work on feet on street model. Is that correct? Or it's because I visited branches in Western India, so I want to confirm that.
I agree. We were not, at least to a certain extent, I agree, we were not feet on street model. But that is what we are changing. Now, with almost all the branches having an exclusive sales staff, at least one person will be in the street road. And we are monitoring his or her performance on a daily basis, how many new logins this particular sector is bringing us. This is in addition to the other verticals like a DSA or a walk-in model. So the exclusive person who is earmarked for sales, he is supposed to bring in fresh business. That is the expectation. But it is still a process which has just started 1 month back. So going forward, maybe if you visit the same branches 2 or 3 quarters hence, I think you will see a change.
Yeah, definitely, sir. I saw a lot of changes and staff were really motivated. I was just thinking about the branch productivity. Second question which I had was, what about portfolio in stage 2 and stage 1, only a portion of 0 to 30 and 30 to 60 and 60 to 90, what percentage of portfolio?
Okay, I agree with you, sir, because of the software changes taking place, we are unable to zero in on the correct numbers as far as stage 2 and stage 1 are concerned. Definitely going forward, maybe in the next 1 or 2 quarters, we will be giving you the precise numbers. Because still there are some number issues. Definitely in the next 2 or 3 quarters, we will be able to give you the exact numbers in stage 2.
Sir, one more question. What is the actual credit loss which we have actually suffered in the last years? Whatever you can recollect.
Oh, I am just 1 year old. Anyhow, I will try to give you.
In the last 3-4 years, what the number you have?
I don't have exactly. Yeah. Anyhow, I'll try to give you just before the end of the month. 5 years you are asking. Actually, sir, last year I can tell you, last year and the current year. This particular quarter paid only around 5 crores, less than 5 crores credit cost. I think last year paid around 25 crores, madam.
No, I'm not talking about the provision, sir. I'm talking about the actual credit loss you have suffered because you have auctioned the property at a lesser value than loan outstanding.
That will be very, very less. Sir, right from inception of this company, the actual write-off will be around 10 to 15 crores. Actual write-off. Maybe another 10 or 15 crores may be there, which we have to write off. That may be there. This is throughout the history of the company.
Nice to know that. So coming back to the first point, you are saying that you will be adding feet on in every branch at one employee.
Yeah.
Okay. So, and that will manage any TSA, outsourced TSA, or he will source still himself?
No, our direction to a particular employee is other than TSA. That should be, we call it as a direct channel. Our employee channel. DSA channel should be different.
Okay. Thank you, sir. Thanks a lot.
Thank you. The next question is from the line of Aviral Jain from Singular Gov. Please go ahead.
Thank you so much, sir. Mike, I have 2 questions. One is if you can quantify the ins and the outs for the quarter and what changed on ground so that you are attracting the ins. That had been our constant ask from the previous management to focus the ins and also use the outs. So where are you seeing these ins from, and if you can quantify these numbers? And consequently, is there a fundamental borrower profile change that you are observing when yields are improving, market is very competitive? Those are my 2 questions.
Okay. As far as BT ins are concerned, we got a BT in of 78 crores last quarter. BT outs, it is relatively difficult to measure because we do not know what are the exact BT ins. But approximately we can say that it should be around 4 to 50 crores. So I can say confidently that in first quarter our BT ins were more than BT outs. To that extent, I can be confident. As far as borrower profile is concerned, we have not seen much of a change, which is in the last 1 or 2 quarters. We have not seen much of a change. Our existing borrowers, our existing clientele remains the same. But going forward, if we are slightly aggressive in the salaried segment or in the documented segments, maybe our home loan portion, housing loan portion may slightly go up. BT ins are mostly from housing finance companies whose interest rates are slightly higher. So if we become slightly aggressive in our interest rates, we will be seeing an increase in the home loan portfolio, the home equity portfolio.
And in a mix of both home equity and housing loans.
Yes. Because normally they come not only for taking over, but also giving add-ons. Normally they come with an additional to the existing loan proposal, existing loan quantum. So that is also being given there. For that reason they are coming. That is one, in addition to the interest rates. Second, as we are also seeing, tracking the movement of our customers, wherever we are seeing an indication that some of our customers may move out, we try to contact them and see whether BT outs can be prevented.
There is a special monitoring team which was just checking still hits and other hits on your existing borrowers. Are you doing something like that in motion at branch level or at the central level?
At the head office level, we are monitoring through our links with the central agencies who, like CIBIL, who give us reports about the likelihood of our customer moving out. So
number of hits. Correct.
We try to contact them so that we prevent such BT outs.
And are BTN's average yield on BTNs higher than the overall portfolio, like for like, or is in line with your overall book?
If it is higher, they do not move in. No, actually they will to me only if there is some concession or some reduction to them. So it will be online. Of course, we do not sacrifice because of BT in. We do not reduce our normal interest rate. So they move in if it is favorable. If it is competitive to them, but their existing portfolio, they move here. And
let me ask you this question. Yeah, sorry. Let me ask you a question, sir. So we are seeing a tremendous growth in affordable housing finance like NAPS or Aavas or an Aadhar, HFC. They have much higher yield. Their average yield is roaming around 13.5%, 14%. Even for a NAPS, it's much higher. And they are showing pristine asset quality. So is the hunting ground to that target where seasoned borrowers you can actually attract at 11.5% of borrowing rate?
We don't target, Mr. Aviral, we don't target any specific company or specific things. People come based on our rate. Maybe word of mouth publicity goes. They see what is our interest rate and all. Our people, when they move out, they find out what is our interest rate. So such things come in the natural fashion. It is not any aggressive to particular company or sector. This BT-ins moved mainly because of our interest rates which is the competitor.
I completely agree with you. So with verticalization of sales, there will be a situation where you will have a lot more effort and a lot more effort by your team on ground, the direct channel. You would want to be it could be a special market or it could be a from a housing finance company. We should be seeing some health traction here, right? Given the verticalization that we talked about.
Definitely. That is one thing that may happen in future. Of course, this I would like it as the sales vertical is concerned. It is still in the nascent stage. Okay, we need to train them. We need to tell them how it has happened and all that. Maybe 1 or 2 quarters down the line, the sales vertical will bring in enough to us. It will save on cost as well.
Yeah, and curiously, so how were leads being generated earlier? It was just walking into a branch and there was no outreach as such? Just very...
there was outreach, but it was more informal. Now we are standardizing the so-called outreach. Earlier, if you recall some years back, we used to have some training camps. But this training camp is no more happening. It is not popular everywhere because of the competition that's there. So slowly, it was more, especially in the south, our popularity, our brand value itself was bringing in business. But now that competition is becoming intense, now we need to go for outreach. So that's why we have done this. And earlier, let us say 1 year or 2 years back, not only our outreach, not only our publicity or our brand, some sort of an informal thing from our existing customers also brought in new business. But now we want to be more nearer to the customer, more nearer to the new customer. I think this vertical is going to help us in that fashion.
And aspirationally, 2 years down the line, would you aspire to outgrow the 20% target disbursement growth, the organic disbursement growth, given so many blocks have been put in place?
Who will say no? Yeah, suppose I have growth more than 20%, I will be too happy. Definitely.
Okay. Sure.
Once I see the momentum, we will be resetting our own hurdle.
Okay. That's good to know. Thank you so much.
Thanks, Aviral.
Thank you. The next question is from the line of Sarvesh Gupta from Maximal Capital Private Limited. Please go ahead.
Good evening, sir. Sir, this change in the mix in favor of home equity has been very sharp from 20.7 to 3.1%. Mentioned that part of it might do some changes in the classification norms, which would have happened during this quarter. So what is that, sir? That is an important number that we would want to know.
See, we do not actually target for non-home loans. So whatever is coming, we take. It is not that the growth is happening only in the non-home loan segments. One, of course, as you yourself mentioned, it is because of the change of reclassification has happened. But some of the home loans also, we ourselves have classified, as I was telling, it will be a pure housing loan, but when we notice there's more than two pitches, or it may be a place where he will be building a house. In addition, he will also be constructing a small shop in front of his house. Such things we classify under home equity. These are all reasons why this home equity portion has gone up. There is nothing, I want to assure that we are basically a home loan company, and you will also be knowing that we can go even up to 40% of non-home loan portfolio. We are only around 33%. So we are very much in the supervisory now. And we are not actually aggressive. I do not have any such notion that we are slightly aggressive in non-home loan portfolio. No. It is happening, whatever is coming to our we take. And this classification as well as, especially in the new software, we are very, very clear. Unless it is pure home loan, we cannot classify under any other category. So all these are coming into picture. Only because of this sort of classification, there is an increase in the home portfolio. Otherwise, we are pure housing loan company. We will continue to be a major housing loan company.
Understood, sir, but it will be, good to get that number. Maybe after the call, it can be shared offline.
On what?
So is one. Second is, sir, if I look at your employee cost on a YOY basis and QOQ basis, it is up 17 and 0%. And the numbers are up only 2%. So does it mean that on an average percent inflation in salary has happened from last year to this year?
Okay. See, I told in the initial stage, so we did a revision in salary which is from January 2023. In fact, we paid out to the employees during this first quarter. We paid in June along with the arrears and all we have paid. So this is one of the major reasons why there has been an increase in the. And you should also factor that there has been an increase in the cost of living over a period. So that has also been factored. All these, we are hopeful. One, the productivity of staff should increase based on this because we are also going to ask our staff members. And second one is there was an addition of around 18% last year. We are confident the revision in salary, the addition number will definitely come down, and we will have more people who are well trained in our company who will be there in the company, which will give us better productivity. That too, we are going for speculation and all. It will help us because the trained staff will be in that will help us in increasing the numbers. And despite all that, we are also keeping an eye on the cost to income ratio. It is somewhat under control. Going forward also, this is the same thing. And we do not expect any major increase in the coming quarters because already these things have been factored. We have been, the establishment cost is increasing around 1 crore per month. It has already been factored by us. We are confident that increasing income will take into account this establishment cost increase.
And what is your NIMs have also spiked up in the last few quarters.
Can you please repeat,
sir? The NIM percentage has also gone up relative to the earlier levels. Okay, what's the sort of the levels that we want to maintain? I mean, if we are going to be very aggressive on the non-home loan segment, the NIMs can maintain, but then you might see more gross NPAs stress building up later on. So how are you thinking about the NIMs as such?
Okay. See, I would like to repeat, we do not want to be aggressive in any one segment, leave alone non-housing loan segment. We want to be as like what we had as far as book growth is concerned, both home loans and home equity should be that up. This is our expectation we want to push. Maybe in the first quarter, you would have seen some increase in this. One thing we want to be clear, whatever is the cost increases, we want to pass it on. We do not want to bear cost increase. This is one thing that we are conscious. Otherwise, I think going forward, it will be the same. We have given a guidance of around 4.7% or 4.8% of NIM. Even though in the first quarter NIM is slightly more than our guidance, it will stabilize around 4.7, 4.8% by year end. Once we increase our home loan portfolio, especially to the salary segment, which is slightly competitive, where I have to give some concessions to get the customer.
Understood. And finally, on credit cost, I think this has gone down a lot, and maybe because of the reduction in the gross NPA numbers. So maybe in case you are targeting another 100 crore decrease this year, then they will continue to be subdued. But what is the sort of realistic steady state number in terms of the credit cost that you are looking at?
We have given a 25 crores, I think, right? We have given a 25 crores thing that year. We would like to make that. We do not want to increase.
So this year is fine, sir, because this still is coming down from a higher base. But then, maybe going down 2-3 years down the line, how are you looking at the credit cost given the kind of profile that you are lending at?
Okay. See, we are monitoring. Let us be very clear, sir. We are monitoring whatever is the loans we are giving. So the early mortality or the early overdue, all are getting monitored. So comparatively, we are confident that we will be able to maintain the same level of GNP or NPA numbers, or it will be going. The trajectory will be downward shifting going forward. And we are confident that going forward too, this credit cost numbers will be maintained or even be reduced.
Understood, sir. Thank you and all the best, sir.
Thanks, Harish.
Thank you. The next question is from the line of Raja Gopal Ramanathan from Satakush. Please go ahead.
Hello, am I audible?
Yes, sir.
Yeah. Two questions. A couple of them are data specific. One is, do you have a stock of or a quantum of loans that have been written off completely, but you hope to expect to recover over the next, say, 24 months or so? That's the first one. The second one relates to direct assignments, wherein you indicated numbers for FY23 and Q4 FY23. Some GS were probably onboarded in Q1 FY23, and the balance which was outstanding in Q4 FY23. But you not stated what that quantum in Q1 FY24. I believe that either suggests that direct assignments completely repaid, or you've got to indicate what that is so that you make an appropriate comparison. Apart from that, other questions relate to any specific reasons why you are being conservative with growth. As one of the other analysts pointed out, you have a lot of finance companies which are comfortably able to achieve 20% plus growth in their entire loan book. And we are sort of we are wanting to sort of constrain ourselves at levels around 12 to 15%. So is there any specific management thought behind that? And lastly, if you do prefer to be conservative, then what is the rationale in having a capital adequacy of 36% then? Because you will never be in a position to sweat your capital if you're operating at such growth rates. Shouldn't you therefore be distributing more dividends? Because clearly, if you look at payouts, your payouts are very, very limited. And therefore, it actually calls for you to increase your payouts to improve capital productivity.
So, done?
Yeah, done.
Okay. Thanks, Mr. See, as far as the is concerned, I think we have answered earlier. Throughout the history of the company, we have written off 10 to 15 crores, not much. Maybe in basic rate of book, we will be having around 14 to 15 crores, which we have already sold, but still some things outstanding. But we have been taking it off. We are also seeing some strategies can be worked out to recover even this amount. Okay, this is first thing. As far as direct assignment is concerned, I think we want to be very clear. We had put 70 crores or 66 crores of direct assignment within the disbursement of Q1 of last year as well as Q4 of last year. In Q1 of 2023-24, we did not do any direct assignment. So which means in the disbursement portfolio, there is no DA. As far as book is concerned, yes, whatever we have already sourced, that will still remain. To your specific question, we can say that I think it is around 112 crores. It is still lying. Right? No? It is around 112 crores. It is still lying in our book. Out of 6,655 crores, there is around 112 crores, which is the DA book is still prevailing. But during the first quarter, we did not do any DA transaction. That's what I want to be very clear. AEM growth, Mr. Rajagopal, I think maybe you are a new investor. This company was not doing all that well. It was somewhat negative. If you remember, 2 or 3 years, we were somewhat negative or we were not growing. So from 2023-24, we wanted to be conservative mainly because we wanted to change the curve. So from a negative person, we wanted to do something different. And so we have given a 12%. Maybe going forward, when we see the momentum, definitely in the next year, you will see that our growth rate also will be on par with the industry. The one thing you should also understand, we are now 23-year-old company. Naturally, there will be a repayments. Normal repayments itself is there compared to some of our other people who are relatively new. So that is also to be factored in as far as AUM growth is concerned. That is the only thing. As far as capital, yes, we want to use as much as possible. You will be seeing the change in the coming years. Let us be very clear, the company is making a slow turnaround. I think we need to be a little patient. This is as the name, I am requesting you people, you investors, please be a little patient. You will be seeing results definitely in the coming years.
Sir, I've actually looked at the last 10 years in terms of repayments as a percentage of your open loan book. Okay. And it has tended to average anywhere between 15% to 20% of the opening loan book. So if I were to look at this stat, it tells me that irrespective of whatever era or whatever management has been or whatever cycles the company has gone, this number has not changed much. Whereas what seems to have happened is disbursement growth which happened between 2013 and 2016, which were significantly higher, in between say 25% plus, that seems to have completely collapsed. And now you seem to be trying to sort of bend this curve. So what I'm essentially saying is the home loan business is capital efficient business. And you're actually going to be very, very conservative with respect to the growth. You will only be sort of make yourself more overcapitalized in the process. And why I say this is to look at your valuation. I'm not necessarily saying you should compare with any other housing finance company, but even for you to command a book value multiple, you have to clearly, investors have to be able to see that capital activity improves or your growth needs to sort of meaningfully move up. My point is, look, I'm not dissatisfied with what you're doing, but I'm saying that this is one area where you need to start working on, because there's no point in holding capital in you're not expecting to utilize it in a foreseeable period. That's my limited observation.
Okay, thanks for your observation, sir. See, you will be seeing the working. As far as valuation is concerned, you will agree that valuation is in my hands. It is in your hands.
No, sir. That is actually completely in your hands. Because if you decide to pay out dividends, there is no reason why equity holders are going to complain. Please try to understand, tomorrow when you need capital for growth, shareholders will give you capital for growth if you are able to make the capital productive. It is not in our hands. It's completely in the company's hands.
See, I do not want to get into any bar of words with you. I fully appreciate. I am very, very happy. You have analyzed very well. Definitely, you will be seeing an increase in the dividend payout. Dividend payout alone is not one of the valuation criteria. I think you will agree for that. Hopefully, that Mr. Rajagopal, you will be seeing going forward, there will be an increase in number. There will be more utilization of capital. That will be the growth picks up. We will also see increasing the capital growth. Dividend is one of it. Effective utilization of capital is second. You will also be seeing definitely when I borrow more, when I spend more, all this, when the book increases, definitely this capital adequacy also will come into picture.
I wish you all the best, sir, but please don't misunderstand what I have tried to put forth here. Because when you have excess capital within the system, it also creates a false sense of security, saying that how does it matter? I have all the capital, I can do whatever I want. So it's just to ensure that the company does not take capital lightly and ensures that it works towards making it more productive. That's my limited point. Thank you very much. All the best.
Thank you very much, sir. I take your advice.
Thank you. A reminder to all participants to ask a question, you may press star and 1. The next question is on the line of Akash Jain from Curves Analytics. Please go ahead.
Yeah. Hi, sir. I think obviously has come a long way in the last 1 year under your leadership, and I think numbers are there to see. I have a couple of questions, sir. One is, I think last quarter there was this discussion around stage 2, where you said that clearly the focus for the last 1 year has been on GNPA, and I think successfully the GNPA has been controlled. You also mentioned that your focus will now move to stage 2 because stage 2 looks higher, and we have to get collection process in place in stage 1 control. So just wanted to understand from you where are we in terms of our strategy for controlling. I understand you were not able to give sub in stage 1 and stage 2 this time, but from a strategic point of view, where are we from a focus perspective on stage 2?
As you have said, yes, we are now focusing more on stage 2. In fact, more than even stage 3, we are focusing more on stage 2. And the collection vertical is more or less getting stabilized. As of now, we have 83 people exclusively on collection, covering 150 branches being covered under stage 2. And on a daily basis, this we are monitoring. Of course, we are unable to give you specific numbers because of the change in the software. Going forward, we will be able to give even specific numbers on stage 2. We are slightly aggressive on stage 2, conveying to the branches also on early mortality, bringing to the numbers, following up on check returns, and so on. And I'm confident that in the next 2 or 3 quarters, stage 2 numbers will be less than 10%, which is our guidance. We are confident that we should be in a position to bring down the stage 2 to less than 10%.
So the other question is on stages. Clearly, the number on provision is very low, so I'm assuming there's not too much slippage into stage 3. But can you just give us some numbers? So what was the slippage for this and what?
Yeah, the slippage actually was 56 crores, but we could recover around 80 crores this quarter. So net that's a reduction of 34 crores. Going forward also, we expect, since we are monitoring almost on a daily basis, going forward too, we expect the numbers to come down. To that extent, there will be a release in our provisions, which will help us in containing the provision requirements.
And is it fair to assume that most of the slippage has come from the restructured book, or is it stage 2 non-restructured book slippage as well?
Yeah, you are perfectly right, sir. Most of the slippages are out of the 56 crores, nearly 50% is from restructured book. This will continue also because there is still around 150 to 200 crores in stage 2 as far as this restructured is concerned. But they are slipping in a slow fashion. But I am also glad to inform that we are also recovering from the restructured even in stage 3. So though some 25 to 30 crores would have in the first quarter, we have also recovered a similar quantum from the restructured book even in stage 3. So to that extent, we are confident that this will remain.
And one last question. Like you said, the very strong legal that we have on SARFAESI. So my assumption is that what will be, can you give us a sense of what timeline, for example, if you initiate a process and people may pay up or you may have to possession and sell property and recover. So given that we have also provided 50% of our coverages on GNPA and given the way real estate prices have gone, my that when recovery happens, we will probably recover significantly more than what we have provided. So we will probably write back if I'm not mistaken. So just give us a sense where we write back if my understanding is right, and just a broad timeline perspective on this recoveries start going in from the timelines from the
within 6 months, the entire surface should be over. This is a normal now. But you will understand that it is more a threat which is given to the customer, which helps us in recovering. So once a surplus notice is issued or a possession notice is issued or even an option notice is issued, we do not expect that it will succeed, then only we will recover. It is more from that the customer comes to us, he talks, he comes with some OTS solution on that. I think more than the actual surface, it is the threat or the threat that we are giving to the customer which brings us recoveries. That is how it will speed up. It is not from pure surface action. Surface action, okay, that it goes every quarter we may get, but it is more from the threat of a surface notice that first come for discussion and we get recoveries.
And do you expect write-backs to come? Because we have obviously provided 2% and definitely all these resolutions will end up being significantly higher recoveries than what provided for, right? If my understanding is right?
Yeah, definitely write-backs will come, but write-backs we have not factored in the current year. In being conservative.
Eventually, given that so much of provisions have happened in the last 2 years and happened because of the risk book, etc., over the next 1 year or 2 years, we will see recoveries and write backs. That is at least simple, or my assumption is right in that case, because resolutions are going to happen in the next 12 months, 18 months, right?
It is possible, Mr. Akash. I do not want to give any specific numbers. It's possible. Because as you say, since we are providing more, that gives us a definite cushion feature.
Okay. Thank you so much, sir.
Thank you.
So one small thing before I go to the next question.
Yes.
See, as far as this home equity portion is concerned, it's a mixture, as I was telling. The lab book is split 34%. Okay. Then there is a CRE residential. That is around 11%. There is some commercial construction that is also happening. That is around 2%. So the entire book is not lab. Lab is only around 34%. Just for clarification, I think one of the analysts asked for it.
Thank you, sir. A reminder to all participants, if you wish to ask a question, you may press star and 1. The next question is from the line of Rishikesh Oza from Robo Capital. Please go ahead.
Hello.
Yeah.
Yeah, hi. Thank you for the opportunity. So how many branches are we looking to add in FY24 and FY25?
FY25, we do not have numbers. FY24, I can tell you on that. FY24, we will be opening. Already we have opened 4 centers. I will not say branches. I will have outlets. 4 outlets we have already done. 3 more we will be doing this quarter. Another 8 we have already got approval from board. And maybe some more also we may do. Another 5 to 6 we may do. So at the end of the year, definitely we will be 200 plus.
Okay. And also I missed the number of credit cost. What credit cost are we getting for
25 crores, sir. And
25 crores?
25 crores.
And same 25 crores we are 25 also more or less.
25 slightly far away. 25 we are not so far on any case.
Okay, but we expect the credit cost to be benign in FY25 too?
Should be, Mr. Rishikesh. I do not want to give a guess, but should be, or even less.
Okay.
So as per our trajectory, I think it should be even less.
Okay, got it. Thank you.
Thanks, sir. Mr. Rishikesh.
Thank you. As there are no further questions, I now hand the conference over to management for closing comments.
Well, I think we have covered all the areas. I thank all the people who were in the conference call. I thank everybody. I thank specifically executives for arranging all this conference. Thank you.
Thank you. On behalf of Yes Securities and this conference, thank you for joining us, and you may now disconnect your lines.